Hello, and greetings from Philadelphia. My name is Kate Maloney, and I'm a program director at Wharton Executive Education. Thank you for joining our LinkedIn Live event. For those of you who may not be familiar with us, Wharton Executive Education is a division of the Wharton School of the University of Pennsylvania for business professionals. We offer a variety of short duration, topic-based business education programs led by the same Wharton faculty who teach in our top-ranked undergraduate and MBA programs. Wharton is home to the best minds in business education. Today, you'll meet three of our professors who are excited to discuss one of the hottest financial topics in recent news. Professors Joao Gomes, Nikolai Roussanov, and Itamar Drechsler want to help you better understand SPACs and why they've suddenly become so topical. Please use the comments to post your questions, and we'll do our best to answer as many as we can. Now, it is my privilege to welcome Professor Joao Gomes, Chair of Wharton's Finance Department, to kick off the discussion. Welcome, Professor. We look forward to a great conversation.
Thank you very much, Kate, and welcome everyone. SPACs, Special Purpose Acquisition Companies, have been one of the most spectacular developments in financial markets over the past year or so. 2020 alone, we saw nearly 250 SPAC IPOs that raised over $75 billion in capital in the US. And we now see countries like China and the UK, among others, looking at developing their own versions. These so-called blank check companies proved a hit with investors and many young private companies wishing to go public, as well as several pop celebrities. At one point, it actually seemed that if you don't have your own SPAC, you're nobody. Today, I'm joined by my colleagues, Nick Roussanov and Itamar Drechsler, two of our foremost experts on financial markets and two veterans of our Wharton on the Market Live series, will talk us through how SPACs work, their advantages, their performance over time, and whether they're here to stay. Before we start, however, I'm going to ask my colleague Itamar Drechsler to walk us through the basics of what is a SPAC. Itamar?
Hi, everybody. Thank you very much for joining us. Just tell you a little bit about myself. So I, as Joao mentioned, I do research on financial markets, in particular on issues of how to price assets. And then one of my foremost interests now is the intersection of monetary policy and macroeconomics and financial markets. Let me start by just getting us all on the same page here and briefly reviewing what is a SPAC. So as Joao said, it's a publicly listed shell company that's created to merge, which I put in quotes, with a private operating company. Merge here essentially means to create a single entity that will then, just like the publicly listed shell, trade publicly, and therefore take the private operating company in this way public. From the time that the SPAC lists and gathers money in so doing until it finds a company to merge with, it has 18 to 24 months to do so. If it can't find one, then it returns the money to investors, but that hasn't typically been the case. They usually do. So the SPAC raises its initial money via an IPO of this shell, and investors typically then buy what are called units for $10. The unit consists of a common share, just a regular stock, and a derivative called the warrant. Warrants, as you may know, are basically call options that let you buy additional shares that are created for a particular exercise price. Now, a couple of interesting features are the shares can be redeemed to get back your original $10 if you don't want to participate in the merger. So investors can essentially opt out of doing so if they don't like the proposed merger. The warrants also can actually be detached and sold separately and don't actually have to be returned back if you redeem. So even if you redeem and get your money back, you still get to keep the warrant. What do the sponsors, which are the managers of the SPAC, get for this? Well, they only get paid if a merger actually occurs, in which case they get 20% of the SPAC's equity, so a sizable portion. Another important feature is that at the time of the merger, in order to increase the amount of cash available for the operating company that's being taken public, it's a very common thing that the sponsors will bring in institutional investors to buy additional shares, and these are called PIPEs, private investment in public equity. They're typically large mutual funds, pension funds, sovereign wealth funds. So just to review in terms of the timeline of this, so the stage one, there's the SPAC IPO. The SPAC trades as a unit. Then it breaks apart the common share from the warrant, and you see both of them trading. During this 1.5 to 2 year period, the sponsor searches for a merger target. Then they announce the merger if they find such a company, and that traditionally has happened. The sponsor arranges for these additional institutional investors to buy into the merger. These are the pipes, which is often a very large amount of money. And then there's a fairly short period of time between that announcement and when the merger is supposed to close. So it's quite fast, usually only several months. And investors, the SPAC investors, vote on whether this should go through or not. They can also decide whether to liquidate their shares, redeem them, and get back their money, or to continue as part of the merger. The PIPE investors insert the funds if this is voted through, and then immediately the merged entity becomes traded as a publicly listed company, and the operating company is taken public in that way.
Nick, I think one of the questions that most people want to understand here is, why is this different or better than a standard IPO? For a lot of these private companies wishing to go public, why do they offer a better route? What are the main advantages and disadvantages you can see?
Hello, Joao, and again, thanks to you and Kate for having us here to discuss this topic. Thanks for everyone tuning in. Again, I'm Nikolai Roussanov, as Itamar and Joao. I'm a professor in the finance department at the Wharton School. I do research and teach in a variety of areas involving mostly public equity markets, as well as bond markets, currencies, and commodities, but also in individual financial decisions, including areas known as behavioral finance and financial decisions of entrepreneurs. And I'm very interested in this topic that we're discussing today. Now, before I answer Joao's question, let me maybe start with the big picture and maybe start from the obvious, that the public equity markets are going to be a key element of our capitalist economy. In some sense, a crowning achievement of sort of American capitalism. And going public is a rite of passage for pretty much every entrepreneurial firm, entrepreneurial startup. Now, of course, there are issues with the public markets, but to paraphrase the saying about democracy that's often attributed to Winston Churchill, the stock market is the worst way of allocating capital except for all the others. That is to say that public equity markets democratize access to capital for entrepreneurs, but they also democratize access to investment opportunities for investors. But what we've seen over the last couple of decades is a pretty dramatic decline in the number of publicly listed and publicly traded companies in the US, from the peak of about 8,000 or so in the late 90s that coincided with the NASDAQ tech boom, to about half of that, if not less, in the early to mid 2000 teens. Now there's a variety of reasons for this, and the growth of private equity perhaps contributed to that. But there's a sense that being public as a publicly listed company has become costlier for firms. But part of that is that perhaps the whole process of IPO, the initial public offering, that is, again, the preferred exit for most entrepreneurs, their venture capital backers, and in fact, private equity companies that take firms private temporarily, that process itself is costly, both in terms of the monetary cost that the company founders bear, and in terms of time that it takes to go public. In fact, we've seen the time to IPO increase over these decades quite substantially, and companies go public at later stages of their life, perhaps because they have to really prove their feasibility in a marketplace that's increasingly dominated by the big tech firms. So they need more capital, more evidence of revenue, and so on and so forth. But at the same time, there seems to be a pent-up demand by small, young public firms with maybe great new innovative ideas for capital that they could raise in public markets. That's probably harder for them to raise through additional stages of, let's say, venture capital, but are not really kind of eligible for the IPO process as it's normally understood. For kind of young, capital hungry but pre-revenue firm, the IPO route is really not available, and the SPAC route is really the only viable route for that firm like this to both raise capital and acquire public listing in a fairly short period of time, that also does not suffer from some of the known disadvantages of IPO, such as what's known as IPO underpricing, whereby the favored clients of investment banks underwriting the deals get to participate in the IPO at a lower initial price, and then have the pop on the first day become basically completely missed by the initial owners of the firm. So the SPAC, in some sense, allows the company founders and the VCs that support them to capture some of those quote unquote rents that may otherwise accrue to other market participants, Wall Street banks, and their some of their clients, and maybe share in those gains more equitably with the public market investors, be that the pipes or the individual investors in the SPAC. But so that's on the financial cost side. But I think the speed of the completion of a SPAC deal, which is dramatically shorter than the usual process of IPO, roadshow, and book building process, is of course also a big concern, that for a lot of these firms going public quickly right now seem to be a defining advantage.
Yeah, I have to agree about one thing here is as we've talked to people and sort of read about this and discussed with people who are participating in this, the thing that comes up maybe the most often is the speed aspect of it, which I think I didn't totally appreciate before. Both because the market was hot, and then when the market's hot and there's a lot of money looking for investments, then if you have a company and you want to IPO, you don't want to spend a year or 2 years doing that now, because by the time you do that, it might not be hot. And so, but instead, if you go to try to find a SPAC that'll merge with you, that can happen in a couple of months. But also because perhaps, at least I didn't totally appreciate how arduous some entrepreneurs or investors find the IPO process to be. If one of the lessons that comes out of this is apparently there is a lot of pent up demand for these things, because people find the IPO process somewhat cumbersome. I think that's kind of a revealed belief. That's one thing. A second thing that people often cite, and this one is more of a double-edged sword, is that, as Nick mentioned, if this has been discussed widely, if you are doing an IPO, you basically cannot make legally projections, forward-looking statements about how well you're going to do. And since a lot of these companies are small growth companies early in their life cycle, really what people are interested in is all about the future. And we're in a period of development where there are things, the kind of companies that have gone public through SPACs are like electric car companies. And these companies, like Lucid Motors was an example, are not even selling any cars at this point. So if the only thing they're allowed to report are historical financial performance, there's nothing to report. It's all a bet on the future. With an IPO, that's just legally not allowed, because if you do that and your projections turn out to be incorrect, which, broadly defined is almost always going to be the case, you're not going to nail it exactly, that opens you up to getting sued. But because a SPAC doesn't look like a traditional IPO, it's technically a merger. Well, a merger, so long as you put some standard boilerplate that whatever you say may not become exactly true, then it actually has safe harbor for forward-looking statements. And that's been a big part of being able to excite people or talk to people about SPACs. Though whether that will continue to be, we have to see, because part of the reaction has been the SEC is worried that there's too much frothiness in SPACs. And in fact, just a week ago, opened up to interpretation whether, in fact, SPACs really perhaps are IPOs, and whether they will be exempt will be given safe harbor or not. So that's potentially introduced uncertainty into this. But those are the two main things you hear people talking about for why SPACs give an advantage over IPOs.
So what we've seen in the last few weeks is really the SEC has started to become more important in these discussions, and people have focused a lot on these guidance on treating warrants, which seems to be the biggest concern right now. But I will agree with you, and I'm curious what Nick thinks, that the biggest uncertainty is about how we handle these projections and how we let SPACs take place without without using historical data, but rather being able to make these forward-looking statements about, I'm going to sell $7 billion in 5 years or something, that you wouldn't allow for a regular IPO. Nick, how do you view the role of the SEC? That's something that I think our international audience will be particularly interested in. The rules are different across the world, and we're not experts in every jurisdiction. What strikes you the most about the U.S. rulings and the SEC in particular that has made this possible, and what makes you more nervous going forward in terms of changes of guidance that could impact this market significantly?
Right. Well, none of us here are legal experts, right? We're all financial economists. So looking at it through the lens of a financial economist, I think what the SEC is doing is it's watching the situation and kind of reassessing how heavily it should regulate it going forward. Because so far, they've employed a fairly light touch in that for a while they didn't do anything, right? And now they've said that this safe harbor exemption should not, does not mean that you cannot be sued basically for saying something that turns out to be patently wrong. And I think this is an attempt to fairly, again, I think American style attempt to use market self-discipline rather than heavy-handed regulation, saying that, look, use your judgment. Don't lie to investors, because if you do, the lawyers will come after you. But also not completely squashing this innovation, right? I mean, SPACs have been around for a while, but now this is something that has become really popular, and in some ways, it is fulfilling a need, as I argue, both from the standpoint of firms going public, but also from the standpoint of investors. I think there has been a pent-up demand on the side of investors, in particular retail investors, who have been excluded from participation in the kind of early stage of the life cycle of many of these innovative firms that then turned out to be huge successes, but that there's a unicorn or even pre-unicorn stage. Sort of retail investors are excluded. Many institutions are even excluded. So if you're not a large VC, for example, you cannot participate in that early stage of the company's life, which in some sense is where a lot of its promise is realized. And I think the SEC understands that giving investors access to some of these companies at the earlier stage is maybe not a bad thing. It probably understands that the IPO process itself has issues, and maybe this will lead to a reform of the IPO process itself. But as I said, I think for now they're watching it, and they're not necessarily going to interfere in a very heavy-handed way unless we see some really, really major blow-ups where investors suffer dramatic losses, and retail investors in particular suffer really large losses. But again, it's not clear so far whether that is going to happen.
I mean, go
ahead. Maybe you want.
Well, I was just a brief comment that just like any kind of essentially regulatory arbitrage, which you could call this, I always find it slightly strange in the sense that if it's such a great development, well, we could change the laws for IPOs to allow them to make forward-looking statements. It seems not totally deliberate that all of a sudden it would be discovered that there's a vehicle that kind of circumvents these laws. I mean, these laws are not, acts of nature. They're under our control. So if that's such a great thing, maybe the SEC should go back and consider the original law to begin with. So, when that happens accidentally, I wonder about it. I mean, the idea of preventing that was, is my understanding, is supposed to protect uninformed investors from being oversold things that they will then overpay for. As we discussed yesterday, and Joao, you pointed out that we had the dot-com bubble, it's not clear that IPOs protected people from investing a lot of money in things that didn't have a real business. I mean, the poster child was the pets.com or the globe.com, where nobody even knew what the business was and it was worth all this money. So yeah, I guess I wonder if there's a deliberate sort of message here, maybe that we should go back and deliberately change some laws rather than just waiting for something to happen and interpreting it after the fact.
Let me just quickly answer, Joao, if you don't mind. Answer Itamar. I agree that just sort of relying on the accident seems a bit maybe too laissez-faire. But on the other hand, again, it is a plausible philosophy that let markets come up with the right solution. And I'm not saying that SPACs are the right solution, and IPOs are probably ripe for reform. But I think it's not the same thing as just saying, well, why don't you allow projections to be used in an IPO? I think the difference between the IPO and the SPAC is the role of the SPAC sponsor, something that does not quite exist in the IPO process. Of course, there are underwriting banks, but the underwriting banks are not in the firm in the long term, and their investment incentives are not as aligned necessarily with the incentives of outside investors as they are in the case of a SPAC. Because in the case of a SPAC, the SPAC sponsor's payoff really depends on the firm doing well, but typically they don't just cash out and leave. They typically stick around for some time. And I think the reputation of the SPAC sponsor is on the line when they are acquiring a company, and the investors who buy into the SPAC ultimately, they don't know what firm they're going to be buying, right? They're essentially just buying the skill of the SPAC sponsor and the reputation of the SPAC sponsor. And that is, again, something that does not quite happen in the IPO process. So it's a different process that potentially works better along some dimensions, maybe not as well along some others. It's certainly not a perfect solution. It is something, as you said, kind of bubbled up by accident. But it does seem to have its advantages, and that's why I don't see it being necessarily squashed completely unless, as I said, we see some serious blow-ups.
Mm-hmm. So let me take you through, Itamar described a little bit about the process at the beginning, and I'm just looking at a number of the questions that we're getting. Let me just take you through some of the features of a SPAC that I think people would like to know a little more. One of them is these units that are issued at the beginning, and the financial complexity that is attached to this deal, and what kinds of investors that attracts or that sort of excludes. So these units that are bought at the beginning, as you describe, is a mixture of a common equity portion and a warrant. Talk us a little bit through that. Talk us a little bit about the ability that investors have to redeem, vote, and trade these things.
Yeah, so the complexity of this is one of the most interesting features of this, and takes a little bit of time to get used to when you first hear about it, because it's more complicated than a standard IPO. So just to first recap it. So at the very beginning, what the SPAC issues is this unit. It's a package deal, a combination of a share and some fraction of a warrant, usually not a whole warrant, like maybe a quarter of a warrant. And again, the warrant is a call option. It lets you, at a certain exercise price, I think typically $11.50, buy a newly created share, or if it's a quarter of a warrant, a quarter of a share. Now, those things can be separated and are separated and traded separately within a fairly short period of time after the IPO. Then, at the time after the merger is announced, right? Then there's a couple of months when the merger is going to occur. That's when the common shareholders can vote on whether they agree with the merger going through or not. And there's usually some threshold, not very high, of the number of shareholders who have to agree in order for the percentage they have to agree for the merger to go through. Actually, separate from this, the shareholders decide whether to redeem or not redeem. It's a little bit funny. You can choose to have it to vote for it to go through and yet still redeem your shares. So one is like your vote, and the other one is you vote with your feet. So if you redeem, you just say, I want my $10 back. They give you your $10 back, and you take your ball and you go home. The warrant, though, still exists. This is a kind of something that's I find a little surprising, because you bought it as a package deal, right? It's like you buy a pair of sneakers, you try them, you don't like them, you bring them back, but you keep the shoelaces. Okay, so you get your full money back, but that's the way that it's designed. So now this, I think part of this makes sense. The more I thought about, part of it doesn't, part of it does. The warrants part, I don't know if it, to me, makes as a security design that much sense from the point of view of the common shareholders, but for the point of view of rewarding sponsors who have skill, that can make sense, because basically they get rewarded if the value of the money goes up and they've demonstrated skill. From the point of view of the common shareholders who aren't the ones providing the skill, I'm less sure about it. Now, it did attract, I think especially last year and before it got super popular, a lot of more sophisticated investors who understands these kinds of things, in particular hedge funds. And a common quote unquote strategy for this, which sounds really too good to be true, and is, I think, a bit of a warning, is that hedge funds would buy the units in the IPO for $10 with no intention of ever becoming shareholders in the combined unit after the merger. What they would do is they would keep it till the merger, redeem, get their $10 back, then keep the warrant. So now you've gotten your $10 back, so you can't lose. However, if other people decide to put their money in and go through with the merger, now you have a call option on this combined unit, which still exists. And so if the value of the unit goes up, then you can exercise your warrant and make more money. Now, you could say, when I first heard this, it's like, how is this possible, right? This is essentially an arbitrage, and we teach our students that you can't have arbitrages in a fully competitive market. So something here isn't totally competitive, and I think part of it is that if literally everybody did this, they all redeemed, there would be no merger, and there would be no money in there, and the warrants themselves wouldn't be worth anything. So the only way this strategy does any better than break even is if some people stay in, and the people who do this essentially piggyback on them. My understanding is that with many more of the SPACs and larger SPACs, the percentage of this kind of activity is not as large, but definitely, it's kind of a no-lose situation in that point, and I think that's to me, strikes me as a bit of a design flaw.
Nick, let me just, do you agree, and would you change that, or do you think that, especially people looking out years into the future and whether SPACs will survive or not, or we're thinking about transplanting this to different jurisdictions, are there features of this contract that you find especially unappealing that you would change?
Well, as Itamar said, this seems like a strange design from kind of thinking about first principles, precisely because if everybody redeems, right, then, well, of course, the warrants will become worthless, except for the few people who end up not redeeming and ending up potentially bearing the brunt of the cost. It seems kind of strange. I think the logic of this design has to do with the fact that when this was a relatively new structure, it provided investors with some protection. You get your $10 back, let's say, for sure, but you get to keep some upside. And it's also better from the standpoint of the SPAC sponsor, rather than selling that initial share, let's say, at a discount at $9 or $8. You selling it at $10 or just, let's say, just under, but they give that option. The option is valuable, but the payoff is far in the future, and only if the deal succeeds. So in some sense, you're not, if everything fails, and the SPAC sponsor, again, doesn't lose very much. So I think that was kind of the genesis of this structure. But as Itamar said, as we're going forward, as it's becoming more and more popular, I think the importance of these warrants will go down, and meaning they will get fewer of them, and maybe eventually they will disappear. That is possible, or maybe remain kind of a small fraction of the unit, simply because you do end up with rewarding these SPAC ARB hedge funds for basically kind of getting in early and cashing out and keeping the warrant at the expense of the shareholders that you really want to attract from the standpoint of the firm, in particular the long-term shareholders who are going to stick around for a while. So I think, again, as it's getting harder and harder for SPAC sponsors to raise PIPE financing, something they'll probably need to talk about on its own right, the importance of warrants will diminish.
As an asset pricing person, as a person who writes down asset pricing models, I think through it in the following way: if you keep the current unit, then the rational thing that should happen is, if you think there's any chance that the sponsor has skill and that they'll make the $10 worth more than $10, then the unit after IPOing should jump up to a price that's above $10. That way, if you buy this, you detach the warrant from the common share. Then if you later redeem the share for $10, well, you lost the extra amount you paid up front. That was the price that you paid for the warrant. And indeed, some of these things do trade over $10. So, but that means that if it IPOs for $10, then whoever was able to get in on this original SPAC IPO essentially, earned some kind of, or got paid some kind of rent or premium. And that makes it a lot like existing IPOs, is that you can't get into the IPO unless you are friends of the sponsor, which is actually the case in a lot of these things. So they're not as democratizing as they might sound. The alternative, though, in terms of design, I think, people say that you include the warrant because you're selling more, so you can raise more money that way. I mean, you could sell more shares. You could sell a bigger fraction of the, you can eliminate the warrants, and then each share will be a bigger pro rata fraction of the money, worth a bigger pro rata fraction of the money that you raise. So it's just a security design question. So I think it would, to me, make sense. They could run these things without the warrant. You still have a redemption option. If you want to redeem, you redeem. You decide you don't want in, but you don't get the warrant. Or if it could be the case that if you don't let people separate them, then if you redeem, you lose both the common share and the warrant, right? If you return the shoes, you got to bring the shoelaces with you. Where I think the warrants make sense is as a way to compensate potentially the sponsor. It's has its own issues. The sponsor might want to jack up the volatility of this to make the warrant worth more. To the extent that they're simply buying another company and cannot directly control the volatility of it, then it's less of a concern. But I could see that, if you're able to generate value, make the value go up, then you'll win to that. And then we're compensating you for your skill. If you can't, if people think that it's no good, they vote against it, you won't. But why the warrants can be detached and why the warrants are given to the unit buyers, that is less clear to me. And I think the way it's working now, you're basically going to give a premium to the people who can get into the IPO, and that's not really different than current IPOs.
It seems we're getting a lot of questions about this, but one thing that strikes me about the financial complexities is almost designed not to make this product very accessible to retail investors, right? And maybe Nick, you can talk a little bit about who actually gets into these SPAC IPOs at first anyway, and who holds them. But one feature that I really like is this ability to redeem if you don't like what management put up. I think that gives a lot of potential protection to investors, and that's a really nice feature. Of course, the flip side of that is if a lot of people redeem, then you don't have enough capital to go through with the merger, which creates a need for an injection of capital, which are these private investments in public equity, or PIPEs, that Itamar mentioned. Talk us a little bit through how you see this from the point of view of investor protection. Is this an investment that you think is suitable, all said and done, for retailers? Who gets involved in this? Who does these PIPEs at the ends, and how important they are?
Right. So it's a good question. I think there is a little bit of a complexity in this product, and Itamar described it very well, that makes it a little bit tricky for many retail investors, in the sense that to really benefit from the protection that the redemption option and the warrant provide, you have to be able to participate in the IPO or buy the unit, which includes the common share and the warrant, kind of right after the IPO or soon after, before the end of this green shoot period, when the two split and start trading separately. In particular, since the redemption option is basically you redeem at $10, say, it's important to be able to buy into the IPO at about $10, right? Because if it starts trading at 13, well, you get that share, maybe even with the warrant, but you can only redeem it at 10. So really, you're now betting on the skill of the IPO of the SPAC sponsor, right? Their ability to generate really valuable deal that will be worth more than, let's say, 13. all said and done, including the common share and the warrant. But after the split, right? If you're going and just buying SPAC common shares, or you'd say you buy an ETF that consists of SPAC common shares, that's it. You really have no protection. Again, the protection is limited by that $10. If the stock is trading at 13, 14, whatever, that extra valuation is not protected at all. So you could of course lose money as well. So this is not a kind of such a straightforward product for a typical retail investor to benefit from, even though in principle you can try to participate in the IPO through your broker if you use a real prime broker. You could potentially get an allocation, or you might be able to buy the unit right after the IPO. For typical retail investors, that is probably not the option. But let me say something else, though, because I mentioned this democratizing feature of public equity markets. I think the bulk of retail investors benefit from this democratization, not because they can buy directly the stocks at the IPO or after the IPO, but because they own diversified vehicles, they can participate in the public listings, right? Most investors own mutual funds, if not directly, then through their retirement plans, and most retail investors, that is. And here, the role that these large diversified institutional investors that ultimately channel retail investors' money into companies is quite central, right? These SPAC deals rely on the participation by these pipes, and pipes are generally firms like BlackRock and Fidelity and Wellington and so on and so forth, that ultimately will be putting the shares of these SPAC companies into their mutual funds. So ultimately in the hands of retail investors, even though kind of indirectly. And of course, these are highly sophisticated institutional investors who are going to make sure that they're getting a good deal if they participate in these SPAC situations. And I think that by itself really kind of protects the retail investors a lot more than the warrant and the redemption option, because betting on that is kind of a tough thing. Because if you're not a professional, if you don't have a really good relationship with your prime broker, and so you can get the allocation in the IPO, the chances are you will not be getting this sort of free present in the form of a $10 unit.
Mm-hmm. Itamar, I'm going to get your reaction on that and how whether this is this democratizes access to different portfolios of firms. But I just wanted to say nothing about this security that is sold at IPO is set in stone. This is being designed to appeal to a particular subset of investors, and it could change, and it could conceivably be different in different countries, right? There's nothing here that is virtually every feature could change, right? Yeah,
and some of these things do change a little bit. For example, one of the big recent SPAC mergers, the merger hasn't happened yet, but the proposed merger was Lucid Motors, which is started by one of the main engineers or manager of the engineering for Tesla. It's one of these electric car startups. In fact, probably the one that's one of the furthest along, because from what I understand, they believe that they could have a car in production already by the end of the year. And that was a very big deal. And there, for example, the pipes who came into the deal bought into the deal at a higher price than the IPO, meaning the pipes are usually, well-connected, large institutional investors actually had to buy at $15, whereas the IPO was at 10. Now, 15 was a pretty good deal, given that people got really excited about this, and I think had a very good sense that it was going to happen. So I don't know if leaked is the right word, but they could guess where it was going. And so actually, before the announcement, the SPAC traded way above 15. Okay, now I think it's down to like 22, but I think it was 45, 50. I don't remember exactly. It was very, very high, and actually fell after the announcement. So apparently some people were buying it beforehand. That's one of the sort of crazier stories where they ran up the price so far in advance, thinking that this was a wonderful thing. that it actually fell a lot afterwards. So we're not talking about redeeming at 10 here is worth nothing to you if you bought it at 40 or 30 or 20. But yeah, so in that example, that was an atypical thing for the pipes, and they brought in a lot of money. So yeah, I think these things are fluid, and they could change, and probably some of the things should change, and none of it is written in stone. And some of them have issued less warrants, notably in order to tell people that they create less of this, quote unquote dilution. I want to say one thing about the historical performance. So these things have been around for a while, but most of the deal flow has been since 2019. There are a couple of earlier ones, like the SPAC that brought Burger King public and like 6-7 years ago, but otherwise most of them is 2019 onwards. And so the performance is very hard to really say because you haven't had that much time to see these things. But there's a nice paper out of some people in the University of Florida looking at all of the SPACs that have happened. And so far the basic conclusion is that during the SPAC time, when you can buy the unit, okay, if you bought the unit and quote unquote did this arbitrage, the returns there are very reasonably good, solid. They're almost never on average negative for the reasons we've discussed. And I think that will change as people realize that and bid up the value of the unit right at the outset. So if you buy in then, the returns aren't going to be as good. But since they didn't realize that, the returns have been very positive. After the merger, the de-SPAC period, then the returns on the common shares have been pretty bad, actually. Not super bad, but definitely most years on average negative, whereas the returns on the warrants have still been fairly positive. So to recap, if you bought in very early, at least till the market figured it out, the returns have always positive. Once you actually hit the merger, the common stock has done not so great, suggesting that things were priced in, and the warrants have been volatile but have done pretty good on average.
Mm-hmm. Nick, let me use that as a transition. One aspect of the SPACs we haven't talked about is the compensation of the sponsors and management, which is about 20%, and you're going to tell me more detail, 20% of what. How does that affect the way they go about identifying targets, good targets, bad targets, particularly in light of the evidence that Itamar just told us about the performance post or on the de-SPAC stage? How do you think of that? Do you think that's too high, maybe too low? But how do you think that changes the incentives? And also one question that we keep getting asked is how much detail do the sponsors need to provide at the beginning in terms of how specific of a sector, let's say, they have to indicate that they're going to get into? Is it just anything? Does this be energy? Do they need to narrow it down much more than that?
Yeah, thanks, Joao. So, of course, the role of the sponsors is quite central in this. And I think the success of the whole model of SPACs depends on whether the bulk of the SPACs that we see are the ones that are done ultimately by highly skilled and reputable sponsors. Because, we know all these SPACs with lots of celebrity names in them that really do not, I think, strike much confidence in many of us as having really serious skill in identifying good companies and conducting good deals. Of course, there are people working behind the scenes there as well. So this is not to say that none of those will be successful, but I think ultimately the success of the SPAC is hinges on the skill of the SPAC sponsor. And of course, the incentives have to be aligned, right, to make sure that the SPAC sponsor is working as hard as they can. Now, so far, returns for SPAC sponsors have been very high. They've been in hundreds of percentage points on average, at least, of course, during this boom period that has dominated much of the recent history, in terms of the number of deals. And that's because really the only way that the SPAC sponsor loses money on the deal is that if the deal doesn't go through and the SPAC ends up being dissolved, and then all of the resources that the SPAC sponsor has put into arranging things, right, all the costs that have been paid, will be forgone. But in some sense, it's a very, very, very high powered incentive. It's a very high delta option, right, where if things don't go through, you lose what you put into it. But if things do go through, your upside is quite substantial. Not only do you get the 20% of of the SPAC capital. Now, again, that's not including the pipes that are brought in on top of this, but of course, you also getting the upside from the ultimate success of the deal on those shares that are 20% that the SPAC sponsor gets. Now, of course, going forward, I think we will see this share that is captured by the SPAC sponsors going down. We've seen recently in some of these largest, in fact, deals like the Altimeter deal with Grab last week, the pipe capital actually dwarfing in a sense the capital that was brought in by the SPAC. So of course there the SPAC sponsor then is capturing much smaller percentage. Now it's still a large amount of money in absolute dollar numbers, of course, but I think as we go forward, the pipe capital will become more and more important component of the total deal value, which of course then brings down the share that is captured by the SPAC sponsor. But again, still, I think fundamentally the incentives for the SPAC sponsors are well aligned to conduct a good deal, to close the deal, and not let, of course, all of your investors redeem, because if all of your investors redeem and you just end up standing there and in fact backing up those warrants that might become worthless, but still. Of course, the SPAC sponsors are there for a reason. They think that they know what companies to go after, even though they don't advertise that when they set up the SPAC. Typically, most of them will announce what area they're targeting. So many of these SPACs, for example, have been in fact started by venture capitalists or private equity firms that work in a particular area. Of course, some of the popular areas have been recently, of course, tech, electric vehicles, lots of other kind of green technology, but also we've seen kind of this explosion of consumer-oriented tech and communications in Southeast Asia. We've seen kind of a boom in some sense of retail firms around the globe, despite the pandemic recession, in fact. That have also been attracting capital, attracting interest from SPACs. So a lot of these SPACs are specialized by sector, by the type of company they look for, but by no means all. And some of them are, I think, just basically advertising that, well, we have somebody who is highly skilled at finding good investment deals at the helm, and they manage to attract a lot of capital that way.
Itamar.
To be clear, they're actually not allowed legally to know what company they're going to buy. So I mean, there's no thought police, so who knows? But yeah, that's legally they're not allowed to have a target, right at the outset. To me, 20% strikes me as fairly arbitrary and very large. I don't know what the origins of that is. Hedge funds traditionally got paid 20% of the upside, though, which is different than having 20% of all the equity. And even the 20% of the upside on hedge funds, that's been coming down somewhat on average. So I don't know where they got the 20% of all the SPAC equity. Again, it strikes me as very high. I could think of more direct ways to compensate someone for the perceived skill that they brought. For example, if you have a pop on the day of the merger announcement, so the market thinks you did a good job, you found something good, I could see somebody getting 20% of that pop so that they capture the perceived value added that they brought, or maybe 20% over some period of time, that a short period of time relative to the merger announcement. The warrants in principle do this, but the warrants are 5 years. And so now you're capturing, a percentage of, all of the risk premium that you would typically earn on an asset. So that's no longer necessarily your value added. That's just that's just some percentage of just the appreciation and the value of the asset due to its systematic risk. So, I mean, if it was up to me and I was thinking in theory what I would do, I would make it connected to the market's vote on whether you added value by finding this or not, and leave a window around which you would get a percentage of it. Don't really see personally how giving 20% of all the equity, much of which is not value added, achieves that, but maybe I am not seeing the reasoning here. In any case, yeah, so I think I think that's probably, if it was up to me, something that would be up for discussion.
So let me turn to sort of a final set of topics, which I think bring us back to the beginning. And from them, I mean, do you guys think this is an innovation that is here to stay, in light of the SEC's renewed attention, which to me seems a bit like, I think you described it, Nick, a little bit of trying to sort of figure out whether there's some investor protection issues here or not that require more of a heavy-handed intervention or not. And it still doesn't strike me as that they've made a decision that this is a market that is just subject to a lot of failures and needs regulation. It's more trying to dip their toe on it. But I'm curious to see what you guys think. Do you think the SEC regulations oversight is going to be important? Do you think liquidity and interest rates have played a big role here? Or do you think it's really the IPO process is broken and this is just a big innovation that really speeds up how private companies go public, and there's a lot of value here for the economy at large, really for investors to be generated, and so this is not really going to go away. It might change, the competition might change these 20% returns or compensation for sponsors, but it certainly won't make SPACs go away. I'm curious, Nick, you can start.
Sure. I mean, I think it's really all of those things that you outlined together, in a sense that clearly the SEC is watching, as I said, and it's possible that they will interfere in a more heavy-handed way. I don't think any of us here kind of know, or we can read the tea leaves of what the SEC current thinking is and what it's going to evolve to, especially as things unfold. And we could see some of the froth disappearing from this market for the same reasons that we might see the valuations decline across the broad cross-section of markets, right? This is a unique period in many ways. This combination of extremely low interest rates, had uncertainty that has declined dramatically since the March of last year. We have lots of investors with liquidity, cash sitting in their accounts, not knowing what to put them in. And this is kind of a unique confluence of events, will not last forever, and will not maybe even last for long. We could see the bout of inflation that many people have been predicting. We could see the Fed hiking rates, probably not abruptly, but eventually, or we could see the market, in fact, waking up to it faster than it has so far, and this could drive down valuations across the board. It could make this whole SPAC sector disappear very quickly. Not disappear, but shrink back to its pre-2019 size. Let's put it that way. And I don't think the SEC, even though its goal, I think, is largely investor protection, I don't think the SEC has ever been truly able to protect investors from buying overvalued companies. That is not something that it can do, even fundamentally. Think about, again, the dot-com boom that we all talked about, right, where we had companies going through the IPO process, nothing much to show for themselves other than .com at the end of their name, right, and massive amounts of money changing hands in the process, and then the whole thing coming crashing down in 2001, 2002. Would SEC like to avoid a scenario like that? They might like to avoid it, but I don't think they can necessarily do it so easily. I mean, even if they come down hard now on the SPAC sector, it will still hurt the investors who are already in it, and I don't think they want to do that either. So I think they might gradually increase the regulatory scrutiny, but I don't think they will come down on this abruptly. And even if you think about the dot-com boom from the kind of grand scheme of things, the big picture, yes, there was a lot of kind of wealth changing hands, people paying exorbitant valuations for companies that were not worth it, and some other people successfully making money in the process. And then when things came crashing down, that became apparent. But also think about all the investment that was financed by the dot-com boom, all the funding that was raised by a lot of the companies, think about Amazon, that was by many people was thought of as extremely overvalued, not profitable, right? Sky high valuations. Yes, its stock price came down, but somebody who bought an Amazon at its peak in 2000 would still be sitting quite pretty at its valuations today and the returns that it has earned. And all the investment that was undertaken into the internet infrastructure and things around it potentially contributed dramatically to the subsequent explosion in social media and all of what we know today as being kind of the great internet giants of the last 20 years. Maybe would not have been possible if so much money wasn't channeled into that sector during the dot-com boom. So again, even here, the SEC might take kind of a laissez-faire view, thinking that, well, there might be some misallocation, there might be some wealth transfer, some people might suffer, but ultimately we are putting money where it needs to be. There's lots of capital-hungry companies, not just in the US, not just in electric vehicles, but around the world, and again, consumer technologies, retail in Southeast Asia, lots of tech companies in Israel going public through the SPAC process, the companies in Europe. And I think the SEC may not want to kind of completely quash that, realizing that this is potentially an important vehicle for capital allocation, and it's easier to regulate it than try to revamp the IPO process, which has not been very successful at doing thus far.
Let me just take it to Itamar for a couple of minutes for a reaction, and then we'll conclude. What do you think, Itamar? Will the SEC quash it?
Despite all the skepticism that I've voiced, people have noticed about aspects of SPACs. It strikes me that the enthusiasm for them is an indictment of IPOs in some way. I'm not sure exactly which piece of it, but it suggests that there is pent-up demand for bringing companies public, that the IPO process has, not accommodated, if you will. So I don't think this goes away. I do wonder how it develops. For example, I think it's simply an enduring puzzle why traditional IPOs see on average such a pop on the first day. On average, it's big, but you might argue that you can even identify companies, not a subset of them where it's even, you'd be able to identify them a priori where it's even bigger. People have put forth explanations. There's academic explanations. Personally, I don't really buy those. That that it somehow completely makes sense. It strikes me as a kind of a capture, and you hear a lot of people in the industry thinking that it's a sort of a capture of part of the firm value, and that may be part of it, and the speed is part of it. So I don't see this thing totally going away. I do wonder about things like direct listing, which recently has been modified so that companies can actually raise new capital rather than just cash out on some of their shares. That's going back to December of last year. New York Stock Exchange is now going to allow direct listings that raise new capital that you could say is even less regulated than this and potentially lower cost. So it does suggest, though, that these kind of developments are important. So I don't think the SEC is going to squash this completely. I don't think it's going to totally go away. I'm excited to see what potential developments there are. It's been a puzzle that I've never totally understood, why companies don't use more direct listing. But I'm sure that the investment banking advice and expertise in building a book is important. But in some cases, we've seen companies can do it successfully in the larger, kind of more obvious cases. So, that'd be exciting to see what happens going forward. Things are going to change, but I don't think it's going away.
Thank you, Itamar. Thank you, Nick. I think that's all we have time for today. Thank you to everyone for being with us today. I hope you enjoyed it. And you'll join us again in the future, either remotely or on campus in one of our many finance programs. Have a great day. Kate?
Thank you so much, Joao. That is all the time that we have for today. I would like to thank our professors, Itamar, Nick, and Joao, for sharing their perspectives and their insights with us. And thank you to our audience for joining us. If you don't already follow Wharton Executive Education on LinkedIn, please follow our page to stay up to date with Wharton thought leadership as well as program offerings. To join Wharton faculty and intellectually curious peers in a live virtual program or someday soon back on campus, please visit us at executiveeducation.wharton.upenn.edu. Thank you and have a great day.